the open. So any order flow that was sitting outside. So your automatic lines would be along this kind of basic idea. If the price goes up, you mark the bottom. Pretty simple stuff. From that point onwards, your job is to be long, preferably on downticks. This would have been your first opportunity to get long. If you waited till it goes up and then you bought in here, it doesn't make any difference. Now you're working the long side, if you want to work the long side, okay? So now you start looking at these elements. You start asking, was there a way of seeing this before the cash open started against the ABCs, for example? Well, when we look at the ABCs had been really bullish early on, but have just been drifting just now. So I don't think that gives us any particularly strong storyline at that stage. So really we're wanting to try and dive into the internal workings of the market. Let's look at cyclicals through this phase here. See if cyclicals have a bid coming in. Well, the answer was cyclicals had been really quite negative for quite some time here. And then they started to catch quite a ramp up on the bids, and they opened very strongly at the cash open. Cyclicals, bullish equities. Now, obviously that means that as the price tested back in here, I was more inclined to be trying to bid into these lows here as it came back into retest. But obviously, subsequently, we've seen a little bit of cyclical weakness into the highs. And as a result, you've got to start looking at it from that point of view. You've got to say, well, you know, the cyclicals are not really giving me much to work with. So I might be inclined to be leaning towards the short top edge up here at the present moment, working maybe into some stops, thinking about those types of trades. So when we think about the markets, it's not about one aspect of it, is it? It's not about the fact that it's just the cyclicals. We've got to try and go through a few other elements of it as well. We've got to try and ask the question, well, what is the internals doing? What are the highs, lows doing? What's the banker bet doing? What are we getting from those elements? Well, let's take a look at the two elements that we added in yesterday. Let's take a look at the highs, lows, and let's do the chart right down into this 5 second again here. Look. Number one, the highs, lows are negative on the open. Negative on the open. So that's obviously going to be something that when the price rallies and the highs, lows are negative and then getting more negative, you're going to start saying to yourself, wait a second, I should be working maybe into a bit of short business here, which would actually have tied in okay with the fact that we'd got a little bit of a cyclical divergence into the highs at the time anyway. As the price came back down into the cash open price, of course, we could start looking at it from that cyclical advantage that we started to see a cyclical bid coming back in and ask the question, well, what are the highs, lows doing? They're starting to diverge to the upside. It's not a banker buy, but they're starting to diverge to the upside at that point. So what are you going to do? You're going to try and bid back into this. As it retests, it's a no-brainer buy trade. At that stage there, the highs, lows are now positive. We're in banker buy territory, and we're in good shape at that point. Now, what's happened since then is that the at highs, lows have actually traded down into neutral here, and then into negative territory here. Negative territory. So the big question we've got is, well, if that's the case, why are we in through the top edges here? Are they just gaming liquidity? Are they trying to find a nice opportunity to sell into at higher prices? Well, that would be expected, wouldn't it? You'd expect them to try and run it higher in this environment to get short, and that's exactly what they just did. And look at what's just happened. We've just had a big sell-off. Look, very easy to see it. It's easy to trade it as well, by the way. Easy to trade it. I've taken a short trade. I sold it in here as well. I sold it here, and I also sold it up here. So it's just went 29 down to 26 halves, and it still looks like a short work off the top edges, doesn't it? It still looks, every time we get a new high, you mark off the new highs, guys, so that you can start seeing them, okay? And it becomes levels that you deal against. Now, when we're looking at this, we can obviously try and figure out why did you have to be patient on this higher move? There's got to be a reason. Now, it might be that it's pure, total manipulation. Sorry, guys, I've got a big oil trade on just now, so I'm just keeping an eye on this one at the moment. We've got a three-figure long position on oil, and it's on my desk at the moment, so I'm having to manage it out, but we've got about a 40 grand profit on it just now, so I am quite keen to look a little bit of profit on that trade. Okay, I've got myself all positioned. All right, so we'd been buying oil in a downtick into that last little phase. We'd seen a, let me just quickly show you what the trade was. We'd seen a bottom edge that we didn't manage to get. So the trade actually was this buy trade into this area here. We started to see some demand showing up in this phase here. So I started to work some bids into this price area here at 70s. And we've obviously just scalped through the top edge, which is why I was managing out some of that position. So I'd bought some oil into that phase. The euro dollar had just started to catch a bid. And at that point, if I drag it across to an anchoring point, you can see that we started to really generate some nice value in that trade. And obviously, as we break through the 52s, I'm starting to book some of the lovelies into that price just now. So that's what I'm doing at that point. It's just making sure that I don't give back any of this very, very substantial profit that we've just made on that trade. So I'm happy on that trade. We got a big chunk of the volume in this whole area here. It wasn't a lot of volume, but we got most of it, I think, on our own book. So we're happy. I think we're the #1 trader on oil at that phase, you know, in terms of just the volumes. Alrighty, so now you can see what's happened to the Dow Jones. You can see it was a very easy sell trade. And it really was an easy sell trade. Is there anybody that doesn't agree that that was an easy sell trade? But what was the challenge on that trade then? What was the challenge in that trade? Well, the challenge in that trade, of course, was actually the NASDAQ. So if we looked at the NASDAQ, here's what the NASDAQ was doing. The NASDAQ was still quite punchy into the highs, which is why you had to be really cautious with that sell trade, because that's why we got the higher high price. If you didn't know that, you're missing some vital information at that trade, aren't you? But when you start tying in the fact that the divergence is still in here, the fact that we got the higher high price enables us still to work the shorts, so long as we're not seeing a big surge in buying coming into that phase, right? So long as it's not this crazy surge of buying, then this is doing well, guys, up to 52.10s. Then you can understand that this actually still makes a lot of sense in that point. And when we start coming back up to retest, now the NASDAQ's getting shorted, we can start working more aggressively into this phase, because now we're in a hurry, right? Now you'll start seeing the price getting marked down on the candles. The volume will be on down candles, because all the traders are now in a hurry to catch this train. And now the train breaks, and it comes down into the cash open price, where there's what seems to be no more business to be had at the present moment, into the bottom edge here. At that stage, we'd started to see a turn coming back out. We hadn't seen any more advancement here. So that was a nice place to start booking your profits again. And there you go, guys. That's your trade so far. That's how easy it's been to be a trader on equities. This is the this is the S&P, not the Dow Jones. But it gives you a good idea about why in certain things at certain areas. Let's take a look at the Prem during that period. Now, the opening Prem is going to be a noisy, so you've got to just get past the noise, because the opening Prem is going to work out the calculation from the S&P prior to the open. So it's all wrong. This is completely wrong. It doesn't mean anything. The S&P, the MACD only kicks into life once you've got rid of the duration part of it. So this is the part you're looking at here. So into the top edge, you can see that the perfect Prem was switching off. So that gave you even more confidence that this trade was not good, but brilliantly good. Into this retest, yep, it's switching off. So that's good news for that sell trade here. Into this one, you're a little bit more cautious until it switches off, and then you chase it. Down she goes. Into the bottom edge, the sell programs have switched off, and up she goes. So again, another piece of information from the classroom, used effectively to make an awful lot of great trades. This is turning into be a huge trade for us, this oil trade, guys. Huge, because of the size we got in it. I like it. Supply coming in just a little bit at the top edges at 20s, 10s, 20s, guys. So I am booking more. That's why I'm kind of not That's why I'm going away every now and then, because we are kind of active in this market just now.